The silver market experienced a severe dislocation event during the previous trading session, marking one of the most significant intraday price movements recorded in recent years. At the session's opening, silver futures traded at $82.15 per ounce. Within 6 hours, the price had collapsed to $74.30, representing a decline of $7.85, or approximately 9.5%. This magnitude of movement, while not unprecedented in silver's historically volatile trading patterns, occurred with unusual speed and force, suggesting structural rather than purely technical factors at work. The sell-off began during early European trading hours, initially appearing as routine profit-taking following several weeks of price appreciation. However, as Asian markets closed and European volumes increased, selling pressure intensified dramatically. The acceleration phase commenced at approximately 9:30 Eastern Time, coinciding with the opening of New York markets. Within 90 minutes, more than 70% of the total decline had occurred, concentrating the price destruction into an exceptionally compressed time frame. The cascading liquidation mechanics that drove this decline followed a predictable but devastating pattern. Initial selling triggered stop-loss orders clustered at technical support levels, particularly near the $80 psychological threshold. As these stops executed, the resulting price decline activated additional layers of protective orders positioned at lower levels. This created a self-reinforcing cycle where each wave of selling generated the conditions for subsequent waves. Margin call dynamics amplified these effects substantially. Leveraged positions in silver futures, which had been profitable during the preceding rally, suddenly faced margin requirements as unrealized losses accumulated. Traders, unable or unwilling to meet margin calls, were forced to liquidate positions at market prices, regardless of their fundamental views on silver's long-term trajectory. This forced selling occurs indiscriminately, without regard to price levels or market conditions, adding significant downward pressure during the most critical phase of the decline. Algorithmic trading systems contributed measurably to the sell-off's velocity and magnitude. These computer-driven programs, designed to identify and exploit momentum patterns, detected the accelerating downward price movement and initiated additional short positions. High-frequency trading algorithms, operating on millisecond timeframes, executed thousands of transactions that further depressed prices. The speed of algorithmic execution exceeded human traders' ability to respond, creating brief periods where bids essentially vanished from the order book. Exchange-traded fund outflows provided another significant source of selling pressure. As retail investors observed their silver holdings declining rapidly, redemption requests surged. ETF managers, obligated to maintain alignment between share prices and underlying metal holdings, sold silver into the spot market to meet these redemptions. The timing of these sales, occurring simultaneously with futures market liquidations, compounded the downward pressure on prices across all silver trading venues. Market microstructure deteriorated severely during the peak selling phase. Bid-ask spreads, which typically range between 2 and 5 cents per ounce under normal conditions, widened to 15 cents and occasionally exceeded 20 cents during moments of extreme stress. This spread expansion reflected dealers' unwillingness to provide liquidity when price direction appeared uncertain and volatility had reached extreme levels. Order book depth, measured by the quantity of buy and sell orders at various price points, collapsed to less than 30% of typical levels. Cross-market correlations exhibited expected patterns during the dislocation. Gold declined approximately 3% during the same period, though its movement proved less severe than silver's. Equity markets experienced modest weakness, with the S&P 500 declining 1.2%. The dollar index strengthened by approximately 1%, consistent with historical patterns, where dollar strength correlates negatively with precious metals prices. These correlations suggested the sell-off stemmed partly from broader risk-off sentiment rather than silver-specific factors alone. The recovery pattern that emerged following the low at $74.30 displayed characteristics distinctly different from the decline. Within 20 minutes of reaching the session low, buying emerged at significant volume. Unlike the chaotic, disorganized selling that had characterized the descent, this buying appeared coordinated and purposeful. Prices recovered $3 within 90 minutes, reaching $77.30. By the session close, silver had stabilized near $79, recovering approximately 60% of the intraday loss. The characteristics of this buying activity suggested institutional rather than retail participation. Order sizes averaged substantially larger than typical retail transactions. The buying occurred persistently across multiple price levels rather than concentrating at a single point, indicating predetermined accumulation strategies rather than opportunistic speculation. Volume during the recovery phase, while substantial, remained below the panic-selling volume that had characterized the decline, suggesting efficient absorption of available supply by well-capitalized buyers. Derivative market positioning shifted measurably during and immediately following the dislocation event. Open interest in futures contracts declined by approximately 8%. reflecting the closure of leveraged positions during forced liquidations. However, options market activity revealed increasing bullish positioning, with call option volumes at the $80 and $85 strikes rising substantially. This divergence between futures and options markets suggested sophisticated participants viewed the sell-off as presenting opportunity rather than signaling fundamental deterioration. The establishment of $75 per ounce as a meaningful support level derives from multiple converging factors, beginning with the fundamental economics of silver production. Comprehensive analysis of all-in sustaining costs across major silver-producing regions reveals a global average ranging between $65 and $72 per ounce, depending on the methodology employed and the specific operations examined. These figures represent not merely direct extraction costs, but encompass the full economic reality of maintaining ongoing production. Primary silver mines, which produce silver as their principal output rather than as a byproduct of other metal extraction, face particularly elevated cost structures. Operations in Mexico, Peru, and China, which collectively account for approximately 55% of global mine supply, report all-in sustaining costs averaging $68 to $73 per ounce. These figures incorporate direct mining costs, processing expenses, transportation, administrative overhead, and sustaining capital expenditures necessary to maintain production rates. Cost inflation trends have accelerated markedly over the past 36 months. Energy costs, representing 20 to 30% of total production expenses depending on extraction methods, have risen substantially across all major producing regions. Diesel fuel prices, critical for mining equipment operation, increased approximately 40% between early 2021 and current levels. Electricity costs for ore processing and refining have followed similar trajectories, particularly in regions dependent on natural gas or coal-fired generation. Labor costs have experienced parallel upward pressure. Skilled mining labor has become increasingly scarce as experienced workers retire and fewer young workers enter the industry. Wage rates in major producing countries have risen between 15 and 25% over the past 3 years. Additionally, enhanced safety requirements and improved working conditions, while beneficial from humanitarian perspectives, have added to operational costs without increasing production output. Ore grade degradation represents a structural challenge, intensifying cost pressures across the industry. The average silver content per ton of ore processed has declined approximately 12% over the past decade across major mining districts. This degradation necessitates processing larger volumes of ore to extract equivalent quantities of silver, increasing energy consumption, chemical usage, and equipment wear proportionally. Several prominent silver districts in Mexico and Bolivia have experienced grade declines exceeding 20%, fundamentally altering their economic viability at various price levels. Capital expenditure requirements have expanded substantially as easily accessible. High-grade deposits become depleted. New mine development projects now require significantly larger upfront investments to achieve comparable production levels. The average capital cost per ounce of annual production capacity has increased from approximately $15 in 2010 to between $30 and $40 currently. These elevated capital requirements raise the hurdle rate for new project development and increase the silver price necessary to justify investment. Supply-demand fundamentals provide additional structural support for the $75 level. The global silver market has operated in physical deficit for 3 consecutive years, with consumption exceeding mine production plus recycling by approximately 50 million ounces annually. This deficit has been satisfied through drawdowns of above-ground inventories, a dynamic that cannot continue indefinitely without triggering price adjustments to bring supply and demand into balance. Mine production has stagnated despite elevated prices, increasing only marginally over the past 5 years. Total global mine supply approximates 850 million ounces annually, essentially unchanged from levels 5 years prior. This production plateau reflects the combination of deposit depletion, permitting challenges, environmental constraints, and the long lead times required for new mine development. Even with current elevated prices, few new major silver projects have advanced to production stage. Industrial demand growth has accelerated beyond most forecasts, driven primarily by the renewable energy transition. Solar photovoltaic panel production consumed approximately 130 million ounces of silver in the most recent year, representing 15% of total global demand. Industry projections anticipate this figure reaching 200 million ounces within 5 years as solar installation rates accelerate globally. Each gigawatt of solar capacity requires approximately 30 tons of silver, and global solar deployment targets exceed 500 gigawatts annually by 2030. Automotive sector demand, particularly from electric vehicle production, represents another structural growth driver. Each battery electric vehicle contains between 25 and 50 grams of silver in various electrical components, contacts, and circuit boards. With global EV production projected to exceed 20 million units annually by 2026, automotive silver demand could reach 15 to 20 million ounces, double current consumption levels. This demand proves relatively price inelastic, as silver costs represent a negligible fraction of total vehicle production expenses. Investment demand has demonstrated resilience despite periodic volatility. Physical silver investment through coins, bars, and exchange-traded products absorbed approximately 200 million ounces during the most recent year. While this figure fluctuates based on investor sentiment and price movements, the long-term trend shows increasing allocation to precious metals as portfolio diversification tools. Notably, institutional participation in silver investment has grown, with several prominent hedge funds and family offices establishing significant positions. Technical market structure reinforces the support thesis through multiple confirming signals. The $75 level represents the 50% Fibonacci retracement of the entire advance, from the June 2024 breakout at $62 to the recent peak near $85. This retracement level carries particular significance in technical analysis, historically functioning as a key support zone during corrective phases within sustained uptrends. Price action at Fibonacci levels often proves self-fulfilling as traders position based on these widely monitored reference points. The 200-day moving average, a widely followed technical indicator representing the average closing price over the past 200 trading sessions, currently resides at $73.50. This moving average has provided dynamic support throughout the recent advance, with price-finding buyers each time it approached or briefly violated this level. Moving averages serve as visual representations of long-term trend direction, and sustained trading below such averages often signals trend reversals rather than mere corrections. Volume profile analysis reveals the $74 to $76 range as the zone of highest trading activity over the past 90 days. Approximately 30% of all transactions during this period occurred within this narrow price band. High-volume nodes function as magnetic price levels where buyers and sellers previously agreed fair value existed. When price returns to these zones following deviations, participants who missed initial opportunities often re-engage, creating natural support. Institutional positioning data from Commitments of Traders reports provides insight into sophisticated market participants' behavior. Commercial hedgers, the category including mining companies and industrial users, with direct physical market exposure, increased net long positions by approximately 15% during the recent decline. These participants possess superior information regarding supply-demand fundamentals and typically position ahead of significant price movements. Their willingness to absorb selling pressure at $74 to $75 signals confidence and support at these levels. The monetary policy environment confronting central banks across developed economies presents constraints that fundamentally support precious metals valuations, including silver. Central banks operate within an increasingly narrow corridor where policy options capable of addressing inflation without triggering recession or financial instability have diminished substantially. The Federal Reserve, European Central Bank, Bank of England, and Bank of Japan each face variations of this fundamental dilemma, with implications extending across all asset classes. Real interest rates, calculated as nominal interest rates minus inflation expectations, remain marginally positive or negative across most developed markets, despite nominal rate increases over the past 2 years. The Federal Reserve's benchmark rate currently stands between 4.5 and 4.75%, while core inflation measures persist near 3.2%, yielding real rates of approximately 1.3%. Historical analysis demonstrates that precious metals perform favorably in environments where real rates remain below 2%. As the opportunity cost of holding non-yielding assets diminishes relative to fixed income alternatives. Central bank communication has shifted perceptibly toward accepting higher inflation levels as structural rather than transitory. Policy statements from Federal Reserve officials increasingly acknowledge that returning inflation to the traditional 2% target may require economic pain exceeding political tolerance thresholds. This implicit acceptance of elevated inflation represents a regime change with profound implications for asset allocation decisions. If central banks prioritize employment and growth over strict inflation targeting, currency devaluation becomes the mechanism through which debt burdens are managed and economic activity sustained. The debt sustainability challenge facing major economies intensifies the monetary policy constraint. United States federal debt has surpassed $35 trillion, representing approximately 123% of gross domestic product. Interest expense on this debt now exceeds $1 trillion annually, consuming approximately 15% of federal revenues. At current debt levels, each percentage point increase in average borrowing costs adds approximately $350 billion to annual interest expenses, creating powerful disincentives for sustained high interest rate policies. European economies face comparable or more severe fiscal constraints. Italy's debt to GDP ratio exceeds 140%, while France and Spain maintain ratios above 100%. The European Central Bank Its ability to maintain restrictive monetary policy remains limited by concerns regarding sovereign debt sustainability across peripheral Eurozone members. Japan's situation proves even more extreme, with government debt exceeding 250% of GDP, the highest ratio among developed nations. These debt burdens constrain monetary policy independence and increase the probability of currency devaluation as a debt management tool. Fiscal trajectory analysis reveals no credible path toward deficit reduction across major economies under current political conditions. The United States federal deficit approximates $1.7 trillion for the current fiscal year, representing 6.3% of GDP during a period of relatively strong economic growth. Structural deficits of this magnitude during economic expansion suggest deficits exceeding 10% of GDP during the next recession, absent politically implausible spending reductions or tax increases. Demographic trends exacerbate fiscal pressures, as aging populations increase pension and healthcare expenditures, while reducing the working age population supporting these programs through taxation. The United States faces approximately $75 trillion in unfunded liabilities for Social Security and Medicare over the next 75 years. European and Japanese demographics prove even more challenging, with dependency ratios expected to reach levels historically associated with economic stagnation. These demographic realities suggest fiscal deficits will persist or expand regardless of near-term policy adjustments. Inflation dynamics demonstrate greater persistence than central banks anticipated when price pressures initially accelerated. While headline inflation has declined from peak levels above 9% in mid-2022, core measures excluding food and energy have proven more resistant to monetary tightening. Services sector inflation, particularly in housing, healthcare, and education, continues above 4% in most developed economies. Wage growth, while moderating from recent peaks, remains elevated at 3.5 to 4.5% across major economies, substantially above levels consistent with 2% inflation targets. Supply-side inflation factors continue exerting upward pressure on prices across multiple categories. Deglobalization trends, driven by geopolitical tensions and supply chain security concerns, are reversing decades of cost reduction through international trade optimization. Reshoring manufacturing to domestic or allied nations increases production costs substantially. Environmental regulations, carbon pricing mechanisms, and the energy transition impose additional costs across production chains. These structural factors suggest inflation will remain elevated relative to the 2010-2020 period, even absent demand-side pressures. Asset price inflation in real estate and equities has created wealth effects disconnected from underlying economic fundamentals. United States housing prices have appreciated approximately 45% since 2020, while stock market valuations remain near historical extremes by most measures. This asset price inflation reflects monetary expansion and low real interest rates rather than proportional economic growth or productivity improvements. The concentration of wealth appreciation in financial and real assets while wage growth lags creates political pressures for policies that favor debtors over creditors, typically manifesting as acceptance of higher inflation. Geopolitical risk factors have intensified substantially over the past 3 years, with direct implications for commodity markets and reserve asset allocation. Strategic competition between the United States and China has evolved from primarily economic dimensions to encompass technology, military, and ideological spheres. This competition manifests in export controls, investment restrictions, and supply chain reorganization affecting numerous critical materials, including silver's role in defense electronics and advanced manufacturing. Resource nationalism has emerged as major commodity-producing nations increasingly view natural resources as strategic assets warranting government control or influence. Chile, producing approximately 25% of global copper and significant silver as a byproduct, has implemented royalty increases and contemplated nationalization of mining assets. Indonesia banned nickel ore exports to capture downstream processing value. Mexico has restricted mining permits and increased regulatory burdens on foreign operators. These trends suggest supply security concerns will drive consuming nations to hold larger strategic inventories of critical materials. Sanctions and counter-sanctions between Western nations and Russia, and potentially China, have demonstrated the weaponization of the international financial system. Russian foreign exchange reserves were frozen, and Russian banks were excluded from SWIFT payment networks following the Ukraine invasion. These actions prompted numerous nations to reconsider the security of dollar-denominated reserves and explore alternatives. Central bank gold purchases reached record levels as diversification from dollar assets accelerated. Silver, while not traditionally a central bank reserve asset, benefits indirectly as a monetary metal from this broader trend toward tangible asset diversification. The safe haven demand pattern for precious metals during geopolitical stress has intensified as traditional safe assets prove less reliable. Government bonds, historically the primary safe haven allocation, face simultaneous inflation and geopolitical risks that compromise their protective characteristics. Extended conflicts in Ukraine and the Middle East, tensions regarding Taiwan, and instability across multiple regions create persistent demand for assets insulated from geopolitical developments. Physical precious metals fulfill this role more effectively than financial assets dependent on institutional stability and rule of law. Currency devaluation trends extend beyond developed Western economies to emerging markets facing balance of payments pressures. The Turkish lira, Argentine peso, Egyptian pound, and Pakistani rupee have experienced substantial devaluations over the past 2 years. These devaluations create inflation in affected countries and drive local demand for dollar-denominated or precious metal assets as stores of value. Approximately 60% of global population resides in countries experiencing currency stress, creating structural demand for alternative monetary assets. The confluence of technical, fundamental, and macroeconomic factors establishes a framework for assessing probable silver price trajectories over the subsequent 12 to 18 months. 3 distinct scenarios merit examination, each assigned probability weightings based on current conditions and historical precedent. The base case scenario, assigned a 55% probability, envisions silver consolidating between 75. This base case assumes continued industrial demand growth, persistent supply deficits, and stable to accommodative monetary policy from major central banks. Under these conditions, silver gradually attracts investment flows as inflation concerns remain elevated and real interest rates stay compressed. The consolidation phase allows technical indicators to reset from overbought conditions, while permitting fundamental developments to validate higher valuations. Breaking above $85 would likely trigger momentum following algorithms and retail participation, accelerating the advance towards psychological resistance at $100. The bull case scenario, assigned a 25% probability, projects silver reaching $120 to $150 within 12 months. This outcome requires multiple favorable conditions aligning simultaneously: a significant supply disruption at major producing operations, accelerating industrial demand exceeding current projections, substantial institutional capital allocation to precious metals, or meaningful dollar devaluation. Historical precedent exists for such moves, particularly the 2010-2011 advance where silver appreciated from $18 to $49 within 9 months, though such parabolic advances typically prove unsustainable and resolve through sharp corrections. The bear case scenario, assigned a 20% probability, envisions silver declining below $75 and testing the $65 to $70 range. This outcome would require severe global recession that crushes industrial demand faster than supply adjusts, aggressive monetary tightening that substantially strengthens the dollar, and raises real interest rates or technological breakthrough eliminating significant silver usage in key applications. Even under this scenario, sustained trading below production costs appears unlikely unless accompanied by existential threats to major demand categories. Key indicators warrant monitoring to identify which scenario is developing. Industrial production data, particularly in China, Europe, and the United States, provides early signals regarding demand trajectory. Solar panel installation rates and electric vehicle production figures offer specific insight into primary growth drivers. Central bank policy statements and inflation data determine monetary conditions affecting precious metals valuations. Dollar index movements correlate inversely with silver prices and reflect relative currency strength dynamics. Mine production reports and inventory levels at exchanges reveal supply-side developments that could tighten or ease physical market conditions. Catalysts capable of triggering directional breakouts include unexpected inflation acceleration that forces central banks to choose between growth and price stability, major mine closures or production disruptions that materially tighten supply, large institutional allocations to silver announced by prominent investors, or significant dollar weakness driven by fiscal concerns or political developments. Conversely, bearish catalysts include recession onset, marked by declining manufacturing activity, breakthrough in alternative materials, eliminating silver requirements in major applications, or aggressive interest rate increases strengthening the dollar substantially. Portfolio allocation considerations depend critically on investor objectives, risk tolerance, and time horizon. For investors seeking inflation protection and portfolio diversification, silver allocation of 5 to 15% of total portfolio value represents reasonable positioning. This allocation provides meaningful exposure to potential upside, while limiting downside impacts should the bear case materialize. Silver's historical correlation with traditional financial assets proves sufficiently low to provide diversification benefits during market stress periods. The choice between physical and paper exposure involves trade-offs requiring careful evaluation. Physical silver held in coins, bars, or allocated storage eliminates counterparty risk and provides direct ownership of the underlying asset. This approach proves optimal for investors, prioritizing capital preservation and concerned about financial system stability. However, physical ownership incurs storage costs, insurance expenses, and liquidity constraints when converting back to currency. Transaction spreads between purchase and sale prices typically range from 3 to 8%, representing a significant hurdle for shorter-term positions. Silver mining equities offer leveraged exposure to metal prices, as operating margins expand disproportionately when silver appreciates above production costs. Quality mining companies with low-cost operations, strong balance sheets, and development pipelines can appreciate substantially faster than the underlying metal during bull markets. However, mining stocks carry company-specific risks, including operational challenges, management quality, geopolitical exposure, and equity market correlation that can diminish their effectiveness as pure silver plays. Mining equities declined substantially during the 2008 financial crisis, despite gold and silver prices remaining relatively resilient. Exchange-traded funds backed by physical silver provide convenient exposure with reasonable liquidity and lower transaction costs than physical purchases. Major silver ETFs maintain allocated holdings with periodic audits, though investors must accept custodian counterparty risk. ETF expense ratios typically range from 0.5 to 0.65% annually, substantially lower than storage costs for physical holdings. For most investors seeking straightforward silver exposure without physical possession complexities, ETFs represent the optimal vehicle. Risk management parameters establish objective criteria for position adjustment or exit. Technical invalidation of the support thesis occurs if silver closes below $72 on a weekly basis, suggesting the $75 floor has failed and lower prices are probable. Such a development would warrant reducing or eliminating long exposure until market structure stabilizes. Conversely, a decisive weekly close above $87 would confirm the next leg higher has commenced and justify increasing allocation toward upper range of position size guidelines. Position sizing must account for silver's elevated volatility relative to other asset classes. Annualized volatility exceeds 30% based on historical patterns, substantially higher than equities at 18%, or investment-grade bonds at 6%. This volatility necessitates smaller position sizes than less volatile assets to maintain comparable portfolio risk levels. Conservative investors should limit silver exposure to 5 to 10% of portfolio value, while aggressive growth-oriented investors might extend to 15 to 20%, provided they possess tolerance for substantial interim drawdowns. Hedging strategies using options provide downside protection while maintaining upside participation. Purchasing put options at strike prices 10% below current market levels offers insurance against severe declines, while requiring premium outlay of approximately 3 to 5% of position value quarterly. Alternatively, collar strategies, combining purchased puts with sold calls above current prices, provide costless or low-cost protection while capping upside participation. The optimal hedging approach depends on investor conviction regarding directional bias and willingness to sacrifice upside potential for downside protection. Rebalancing protocols maintain target allocation percentages as market movements create drift. Quarterly rebalancing proves sufficient for most investors, avoiding excessive trading costs while preventing allocations from deviating substantially from targets. Threshold-based rebalancing, where positions are adjusted only when deviation exceeds 25% of target, reduces transaction frequency while ensuring portfolio remains aligned with strategic objectives. During highly volatile periods, monthly rebalancing may prove necessary to maintain risk parameters. Counterparty risk considerations prove particularly relevant for derivative positions and ETF holdings. Futures contracts expose investors to exchange and clearinghouse risk, though these entities maintain substantial capital reserves and risk management protocols. ETF holders face custodian risk, though allocated holdings with regular audits mitigate this concern substantially. Unallocated holdings, or complex derivative products, introduce greater counterparty exposure and warrant avoidance by conservative investors prioritizing capital preservation. The synthesis of technical, fundamental, and macroeconomic factors supports confidence that $75 represents durable support for silver prices absent extraordinary negative developments. Production cost economics establish a floor below which sustained trading appears implausible. Supply-demand fundamentals demonstrate persistent deficits requiring price appreciation to incentivize supply expansion or demand destruction. Macroeconomic conditions favor hard assets as stores of value amid currency devaluation pressures and financial repression through negative real interest rates. The probability assessment favors higher prices over the 12 to 18-month horizon, with base and bull case scenarios collectively representing 80% probability compared to 20% for the bear case. However, the path higher will likely prove volatile, punctuated by corrections, testing investor conviction and triggering weak-handed liquidations. Yesterday's decline to $74 exemplifies the volatility inherent in silver markets, where 9% intraday moves occur with regularity. For business professionals and entrepreneurs evaluating silver allocation as portfolio component, the current environment presents favorable risk-reward characteristics. Entry points near the $75 support level offer asymmetric payoff profiles, where downside appears limited by production economics, while upside extends toward $100 or higher. This positioning proves particularly appropriate for capital-seeking inflation protection, portfolio diversification, and exposure to structural trends in renewable energy and electrification driving industrial silver demand. The strategic imperative involves establishing positions at favorable levels, implementing appropriate risk management, and maintaining discipline through inevitable volatility. Silver markets reward patience and punish emotional decision-making. The previous day's decline separated patient capital from speculative positions, clearing supply and establishing conditions for the next advance. Those positioned appropriately with adequate capital and risk tolerance should maintain exposure through consolidation periods, adding selectively on weakness while avoiding overconcentration that could force liquidation during temporary setbacks.